The key takeaways, the most important things that he did was, number one, he surprised the entire market by cutting rates by 0.5%. This is a very aggressive move. Hello, everybody, and welcome to the Unbeatable Mortgage September FOMC update. Jerome Powell has recently dropped very, very interesting news of cutting the rates by 0.5. Like what he said, this is one of the stronger news. And today with me, I have Sham. He is a ex-CFO turned mortgage consultant after retiring. You know, some people want to help people drive Grab. He is somebody that like to fix your problems in his spare time. So without further ado, Sham, say hi.
Hi everyone. As Ethan said, I'm here to help. My main interest is really to help people own homes, and that would be my motive.
Awesome. There will be three parts to this conversation. Start off by first talking about what Mr. Jerome Powell has recently done, what he like not just the rate cuts but the projections and everything. After that, we are going to use all our banks to get the best rates and then determine which rates are best for you to hold on to. And then lastly, we would have some questions and answers by our community. So let's get going with the economic update. First things first, why is this old man so important? Why is Jerome Powell so important? Because Singapore does not control their own domestic interest rates. And typically, this has been below the US interest rates. Later, you'll be able to see it. There will be a slide for the past performances. Okay, the federal funds rate almost directly affects SORA. The reason why is because we are using a exchange rate policy, and because of that, our domestic interest rates typically has been below US interest rate to keep ourselves sustainable. So this is when this chart that contains a lot of forward-looking statement by the Federal Open Market Community, Jerome Powell and his entourage of 11 other people, they are here to be able to make sure that two jobs are done. Number one is maximum employment. Second is stable prices. So the key takeaways are from this FOMC. It's a long video. You don't have to watch it because I already did. But feel free to go and watch it after that. The key takeaways, the most important things that he did was, number one, he surprised the entire market by cutting rates by 0.5%. This is a very aggressive move. And this was made to be instilling confidence in the entire market, to be making sure that the market knows that the Fed's direction is to be ahead of the curve rather than behind the curve. Okay, and in their recent projections, they also say that by the end of this year of 2024, they are going to cut rates even further. Are you able to see the one that I highlight over here? 4.4%. So right now it's 4.83%. It's going to go down to 4.4 with one more rate cut in either the November or the December meeting. They have also revised downwards the future projections like next year, what interest rate is going to be 3.4, 2.9, and then long term. This is quite surprising. They actually revised up their long term and 2027 plan from 2.8 to 2.9. So we want to be able to dissect what's happening in the market. How come they decide to cut this so feverishly at 0.5? Is inflation going to come back up because of the aggressive rate cut? And what happens after that? So let's explore that a little bit, and let's dive into the numbers, the ones that they actually look at projections. Okay, so the first things that we want to look at is the change in real GDP. The current value, the GDP is actually doing very well. Okay, the current value is roughly 3%, and the change in real GDP, they are only expecting 2%. Previously, they were expecting 2.1. So that's why I think that this is a very good sign of the economy. Okay, when you're looking at unemployment, current value is 4.2, and as mentioned earlier, right, in my previous slide, right, there is this report, GECW report. they are telling us, right, that they already tell the Federal Reserve that the jobs number may be artificially high. So if the job numbers are artificially high, means the unemployment numbers are artificially low. Okay, so which is why you can see, right, that the unemployment, although today is at 4.2, they are expecting it to be at 4.4 for 2024 and 2025 and 2026. Okay, it's going to be around this number. Okay, and the next thing that they look at, because full employment is one thing, the next thing is stable prices, where they are looking at these two. The PCE inflation currently is at 2.5. The core PCE is at 2.6. What is the difference between the core and the non-core? The non-core includes the more volatile food and energy, because supply and demand, etc. And supply and demand does change, especially in a volatile global economic condition like this. And the core PCE excludes the volatile food and energy, which is why this is one thing that the Federal Reserves are looking at quite a bit. So when you're looking at the PCE inflation, they are expecting it to go down from 2.5 to 2.3, which means that, and on top of that, the core PCE is 2.6. They expect it to maintain, which means if you are able to read in between the line, they are telling you that the volatile food and energy prices are likely to fall. Okay, and from understanding all of this, then the whole entourage, the whole meeting people, right, will then vote together on what the federal funds rate should be. So after being presented all of the data that is in the page book, all the data that is in the two other reports, for two reports for unemployment, two reports for inflation, they have very decisively decided that they want to lower rates by 2024. The current rate for effective federal funds rate before this is 5.33, according to the Louisiana Fed. How you read this is that out of all of these participants, because there are reserve people also, 7 people of them voted for them to cut to 4.625, and 9 people actually voted for them to cut to 4.375. So they are quite mixed in between here, but this actually shows that they still want to cut one more time. Then the future numbers, once again, is the majority win. So these numbers, right, are based on the projections of the majority. Okay, so that said, we can then look at the inflation data. One of the things that Jerome Powell actually mentioned, right, is that he wanted to see a trend of inflation coming down. So that's why we are going to focus on this last bit. This is the PCE numbers by the BEA. So this is the official source. Okay. So what you can see, right, for PCE, right, a trend line going down 2.7, 2.7, 2.6, 2.5, 2.5. So you can see that the pressure of it going down is there, right? However, if you're looking at PCE excluding food and energy, right, you're able to see it's 2.8, 2.8, then 2.6. Then you drop one time, 2.6, 2.6, 2.6, which is, in my opinion, not a very strong trend lah. Okay, there has not been enough force to push down the inflation yet. But that said, this is my thoughts about the FOMC recently. So they have a dual mandate from the Federal Reserve. Their job is maximum employment and stable prices. And based on the outlook today, it actually looks quite rosy. However, I do have some fears, because I think that maybe Jerome Powell has made a very aggressive move, but hopefully it is for the better for the people lah. Everybody will enjoy having lower interest rates. Stock market prices will go up because there's more money in circulation, so on and so forth. However, these kind of things actually then spur inflation, make inflation something a little bit heavier and it may become stickier, then what happens is Jerome Powell then will have to focus on the stable prices of the mandate again and keep interest rate up again. So the whole this is the whole update of what happened in the latest FOMC, and now we want to tell you what we can do with the mortgage rates portion. And for that, I'd like to invite Sham to be able to share with us a bit more on what we do and what we actually do to help you add value, what rates we can actually look at, and then later we'll go into the projections once again. All right, Sham, please take it away.
Thanks, Ethan. As I said earlier, my job is to help families own homes, and that's what Unbeatable Mortgage stands for. We have 10 banks, a stable of 10 banks behind us. And all these, and as a company, we are certified with the SAMP certification. So therefore, we are a accredited company, and we have a 4.9 star on Google, which means we have more than 600 happy clients. That's a very good standing for us as a company. And the among all these 10 banks, we have both locals as well as foreign banks. You can see in the little corner there telling you what those banks are. And our job is to get you the best rates possible and help you to maximize the loan possible and help you make, most importantly, make some savings. And our framework is really about what kind of strategy should we adopt and how will we help you structure your loan and get you the best rates possible. Now, we help our customers with managing the TDSR as well, and that's part of the strategy.
Absolutely.
Right?
Absolutely.
We manage the TDSR. We help them manage the to maximize the loan possible, and that's part of the structuring. And so these two are really go hand in hand. And with the rates that we can obtain from from a stable of 10 banks out there, we will give you the best possible solution out there for you to own homes.
Right. And Sham, yourself, you already experienced this before a few times already. You show one set of document, an amount of loan gets approved. You show a different set of document, the number can be wildly
Correct.
different.
Correct.
Right.
Exactly. You know, like for example, we'll deal with the inconsistent CPF contribution history. You know how deals with it is very different from how.
And
Yeah.
we are not allowed to talk about too many specific rates because there are banks that do not allow for us to disseminate special rates that we are getting because they know that we are professional uncles lah. They know that we will nitpick, we will choose, we will compare, and then we will kacau them for
Correct.
So got 10 banks with different rules. I got kena one time before. One customer ended 9 banks. Bankrupt and don't pay. So it's jialat one. The banks they remember. They remember lah. They got elephant memory. But the thing is there is one bank that he didn't offended yet. We managed to do. We also have services that are more specialized that require a long period of following up. For example, it can take up to like 3 years for credit repair, and that kind of service we do charge. Absolutely right. The strategy is very important because like if you are intending to sell away your property, right, sometimes the best thing to do is stay still or to go and get like certain advantages in certain terms inside the new clause. For example, waiver of fees upon sale that will save you 1.5% of your outstanding loan size, which can go up to like tens of thousands of dollars, quite a lot of money. So yeah, do speak to us to understand what we can do for you. Our link will be in the description below somewhere. Please click and then we will be in touch. That's a good introduction about our company.
So the question really is, which is better, fixed or floating rates, right?
Right.
And this is what this slide speaks to, right? And if you look at this loan size here on the left and your rates available on the right, you can see that the fixed rates are lower than the floating rates. Why? Because SORA is currently at 3.45, and if you take 3 months SORA, which is 3.45 plus the 0.6, if you are looking at 300,000 loan size, you're really looking at 4% interest rate. It's no brainer that as of today, fixed rates is a better rate. So in my mind, that's what we would adopt for as part of our strategy going forward. at least in the near term, until the graphs meet each other and break even at some point, and then we will relook at whether floating rates would be a better approach.
Just to be a bit more personal here, these rates does not include interesting rates that we have access to. For example, we have a rate from one bank that gives you the first month installment as your welcome bonus. And then if you were to put that into the calculation, the effective interest rate is like what, 2.5 or something like that. It is going to be expiring soon. And on top of that, these kind of rates we are not allowed to physically publish and say which banks are giving this lah. So do reach out, because there are secret rates that the bank don't allow us to say, otherwise we spoil their business. With refinancing, typically the banks are a bit more aggressive in terms of like wanting to get the customer to join them. That's it, right? Our job today is to help you cut through all the BS and to cut through all the noise and to do the calculations with you together to then determine what is the best rate, what should we take, fixed or floating. If we were to project the number, we say $1 million because that's a normal loan size for us. The current interest rate, right, is based, we look over here on the right, this is the floating rate. This floating rate actually takes the SORA, the 1 month SORA lah, and then plus 0.4, okay, which gives us 3.85. So please write inside the comments below right now, pause the video, which package would you want? And if you change your answer later, you reply to your own comment, okay? So you see, at this point of time, it seems almost no-brainer. Wow, the interest amount that you'll be paying, right, if you take the fixed rate is what, 2,002. This is the interest amount. We don't talk about the principal amount because everybody got varying in loan tenures, but we talk about the interest first. 2,002 versus 3,155. So the difference is approximately $950 per month. Sham, I give you $950 per month. What will you do every month?
That's a lot of chicken rice you can buy.
So yes, the difference look very huge, and because of that, it looks almost no-brainer, right? Then over 2 years, you save 22K. Wow, definitely.
It's 1/3 savings.
Let's go for this.
That's 1/3 savings.
1/3 saving, excellent. But the thing is, the value on the right, is the floating rate. And can I ask, Sharp, based on my previous announcement, later I haven't shown the projections yet, but based on what I shared previously, do you think interest rates are going up or going down or staying the same? What do you feel?
Well, the market is all looking to the interest rates coming down. Everybody is looking for interest rates coming down.
Correct.
So it will come down. It's just a question of when. In the beginning of your presentation, you talked about Singapore mirroring US. So
Yes.
when Jerome Powell made the announcement on Wednesday, Singapore will follow in a very short while.
Correct. And I want to take this opportunity to share why Singapore follow US like this. All right. Okay. So in the world, right, in the entire world, there are 3 kinds of economy. One is the got money people, the ones that buy things from people more. For example, places like US, UK, Luxembourg, all these atas place. So they like to keep their interest rate high so that their currency is valuable. So as their currency is valuable, then they take their more valuable currency to go to countries that are producers in nature. Countries such as Japan, countries such as China, countries such as Sri Lanka, and whatsoever, right? So these people are producers that want to keep their interest rate low so that they are able to have the infrastructure to be built faster and so that they can create more goods to sell to people. So there are both sides of the same coin, and Singapore, right? Singapore is the middle of the coin, where we shake hand with the people on the left and the right. Like what Mr. Lawrence Wong said, we can be best friends with China, we can be best friends with US also. So at this point in time, right, let's look back at these numbers. They are actually based on today's value. But like what we said, right, interest rates are looking to go down. Later, we're gonna go into the exact numbers. We're gonna try to get the average. We're gonna go into the details, going into whether we should actually go for fixed or floating rate. Okay, and we will give a recommendation, but yeah, it is not supposed to be taken as financial advice. So, Sam, can you please share with our newer viewers, people who haven't been around before, what is a mortgage?
Well, you can get a loan up to 75% of the value of your home.
Mm,
But there's a caveat to this.
mm,
Sometimes it's not just 75% of the value of the home. It could be
mm,
based on affordability. So,
mm.
it's the lower of each. Yeah. But generally, let's take it as 75% of value of your home.
There are some properties that the banks may or may not like. For example, the Geylang lorongs that are even. So there are some corners, right, that do not have the kind of regulation most other places have. There are some banks that don't even straight away outright say, "Yeah, we don't lend to this." But there are banks that do still finance, but with a lower loan to valuation. Ah, so
Yeah.
that's a important add-on. What kind of
So,
rates are we able to choose from?
yeah, you can choose either fixed or floating rates. Spoke about that earlier on. That at this moment, fixed would probably be something you go for. But really, your monthly interest has two portions, right? It has the principal portion and the interest portion.
Mm,
And your principal, when you make a repayment, you're repaying both the principal as well as the interest. And as you pay, the principal will get reduced accordingly. Now, you can pay your loan back with either cash or with CPF through your OA account. And there are some rules on that as well, meaning that if you ever sell your house, you got to pay back a CPF for the use of CPF. But that's a different story, right? Today is
mm.
just to tell you what's mortgage all about. How do we help you with mortgages?
Absolutely, and because it's the only loan that can be paid back by CPFOA, the default rates are one of the lowest in the entire market. And because of that, the risk that the bank has to take on is lesser. And because of that, the interest rate is one of the cheapest rates you will ever be able to find. And interest rate, right? You minus away inflation because you want to be able to calculate real interest rate, you minus away the inflation, the rate of which money depreciate. The long term is about 2%. Now our interest rate 2.7 minus away 2%, we are looking at 0.7 real cost of financing. And the alternative is rent. So
Yeah.
that's why we love properties in Singapore. We are going to go into some more exciting parts of this webinar. This video, once again, this is when we are going to talk about more forward-looking statement, things that are going to be a little bit more projection-ish in nature. Especially these are my own numbers where we actually do the calculations to be able to help you guys in terms of understanding your interest rate. Once again, there are three kind of categories that you need to be able to make sure that you get correct when you go for your mortgage. The strategy, the structure, and the rates. Okay, your strategy and your structure especially, it can be the determinant of like having a multi property portfolio with little to no additional buyer stamp duty and a lot of interesting things like that. And all of these will once again be in our private consultation. Everybody is different, and when I recommend things to a multi-millionaire versus I recommend a thing to some young guy that is starting things out like myself, uh, the way I share things will be different, and the kind of advice you'll be giving will be different because the kind of objectives are different. So do feel free to come and reach out to us. Okay, so we've already talked about MAS being a bank that does not control domestic interest rate, and that interest rates have typically been below US interest rate. Over the last 19 years, about 4,000 over lines of data, we actually see that the correlation between the two is 94.47%. As somebody that is in finance, I gotta tell you, past performances are not indicative results, but damn, look at this chart. We are not fortune tellers, but with enough data, we are able to make a pretty reasonable prediction And if you are able to look at this data that we made, right, this is the projections that we do when effective federal funds rate follow their projection. So over here, right, this is contingent on the US following their projections over here. Okay, so for example, current effective federal funds rate is 5.33. Today SORA is 3.45. So by the end of this year, they already say effective federal funds rate will be cut to 4.4. Uh, once again, subject to incoming data, etc. But if they cut to 4.4, then our SORA is going to be at 2.85. Later, you need to think about it because we are going to compare the $1 million case again. We will take the average of 2.85 plus 2.2, then this is year one average. Okay, year one average, and then we take these two add together, and then this is year two average. So year one average plus year two average. Then after that, we see whether which way we can make more money, which is why we are going to go into calculations. In Unbeatable, we believe that numbers talk and BS walk. Okay, here are the numbers. Okay, so assuming right that you are choosing fixed rate over floating rate. Okay, in this particular circumstance, we break it down from year one year at a time. Okay, so this is year two. Year one is on the left, year two is on the right. So year one, we save 2.2K in terms of their interest. Okay, roughly about 2.2K. Later we get the numbers out. Yeah, 2.2K in terms of the interest over here. Every month you save 100 plus because we are actually comparing 2.7 against the average of 2.92. 2.92 was determined by taking 2.85 plus 2.2 divided by 2 plus the spread of 0.4. Okay, this will be the numbers, and then the first year you'll be saving 2,000, which is quite a bit of money. And then the second year, you are actually paying extra 2.6K. Okay, so if you take 2.2K plus 2.6K, you will see that the grand total is actually negative $397. So when the numbers are disclosed, when the economy is uh very uncertain, not I mean it is rosy, but once again there may be some sort of resurgence of interest rate, and I think that at this point of time 2.7% is not the cheap, is one of the cheapest today lah. It won't be as cheap 1 or 2 years later lah. But I think it is a reasonable rate to pay, and the $397 worth of premium, right? For the ease of mind, stability, every single month, right? When you receive the monthly installment, right? You will see this number 4055.89. It is dead accurate as compared to a floating rate where your monthly installment can increase or decrease. This helps you with your budgeting, your cash flow, and everything. Which is why, in this circumstance, right, it depends on the person again. If the person is a little bit more aggressive, maybe your view is that the economy is going to cut interest rate faster than what Jerome Powell is projecting, then you can consider going for a floating rate, especially, and as interest rate come down, right? Try to take the 1 month, the smaller average, you will get lower interest rate faster. And if you are somebody that like wants to hedge downside, which is in times hedging downside actually quite useful. Yes, it is additional $300-400, but at the end of the day, peace of mind is more important. Don't you agree, Shem?
Of course, of
Right?
course.
So
Yeah.
so this is a very exciting time for us, especially because this is the first time we may be shifting our recommendation from fixed rate towards floating rate, and this is because of this incoming set of data. Yes, it is losing about 397, but personally, I may take the 2 years fixed rate instead. Mm,
And I agree with you, Ethan. I think in the near term, at least for any refinancing or new loans that are taken now, at this
mm,
moment, in this particular month,
mm,
I think it will still be fixed rates. I think it will still be fixed rates because you have that 33% savings that we talked about earlier on, one third
mm,
savings, right?
mm,
Um, when the 2 years fix is up, by which time, when the fixed rate and floating rate and the SORA rate kind of break even at each other, that's when you need to consider whether you want to go with fixed or SORA. And maybe by the time, it would be the right time to switch from fixed to SORA. That's my thinking.
The recommendation, it depends on what the information is given to us, what kind of reports have been out, what kind of projections, what kind of data has been out before we make certain conclusions. And we do take our job very seriously, because I believe this is when we are actually helping most of our clients get a good idea of what rates to take. And we also have rates that are 1 year you can reprice, right? So there are rates out there that are 2 years fixed, but then after the first year, you get to reprice. Okay. Personally, right, I've got some of my customers that come back to me, because I've been doing this long time. Yeah. They come back to me. They tell me, "Hey, Ethan, they actually offered the repricing." So last year, for example, they get because last year, remember, interest rate very high, then they have the choice of in 4+% fixed, floating, or like 3+% fixed. They chose the 3+%, 3.4, 3.3, somewhere
Correct.
there.
Yeah.
Then the new rates, right, that got offered today, you see, how much interest rate we are normally looking at for market price, right? 1 million plus, right? For that particular bank, I don't want to say names, okay? You know how much they offer my client?
2.6 maybe? 2.2.
3.2.
Oh, 3.2.
3.2. So my client is stuck in a position where, hey, should I take the 3.2 and then get the 0.2 savings and then hold for longer, or just fulfill the 3.4 after 1 more year, then change into a more normal package, which is
Yeah.
what we ended up doing, because sometimes the repricing rate really not too nice. The
Right.
repricing rate, through my experience, I realize it depends on how locked in you are. If you are locked in with them, like what I said earlier, right, the rates that they give may or may not be kind. The most nightmare case I hear is a bank offer 3.75 for repricing. Can you believe it? Yeah, but that is what banks do lah. So what we do is, we are that guy that tell you, actually you don't need to pay so much money. So that is what we do. And that said, right, I want to bring us to our last and final portion of today's conversation, which is questions and answers. Before this conversation started, right, we actually went out to gather questions that you guys be asking. And if you guys have future questions, right, do feel free to put it in the comments below. My team and I will be looking at the comments. Then if you got questions, ask there. If it's a little bit more sensitive, just reach out lah. Things are better when we talk one-to-one. We can talk about more things more freely, out of the watchful eye of the public. Then we can go into more strategies and whatsoever. So yeah, in the questions that we get, right, number one, okay, how do the Federal Reserve projections impact your overall home buying budget and affordability? Okay, so Sham, interest rate is already coming down. Yes.
Yes.
Then the banks usually use the thereafter rates. The most crap rates are the 3 month SORA +1
Correct.
as a stress test.
Yes.
But this stress test, they revise down manually. At this point of time, they haven't revised down yet. It is 4.75 stress test, as you know, in our calculator. So in our calculator, right, if your stress test is lower, the amount of loan that you can get is more. So when more people can borrow more, what happens to the overall home buying budget and affordability? So got two questions in this one. So we are handling, there are two parts to this question. Part one, how does it impact the overall home buying budget? So what do you think the price of the property going up or going down? Second question is, sorry, what do you think will happen to our affordability? Will the prices, will the loan we are able to take be higher or lesser?
Well, for me, I think when the interest rates come down, there will be huge appetite from home buyers to go buy property.
Mm,
So in that sense, the loan size will of course increase, and just because of the huge appetite, everything will be in favor, will be favorable to the home buyer. That means that the loan affordability becomes more affordable because your interest that you pay is lesser, and everything just works out well when interest rates come down. The only problem with that, I feel, is
mm,
what you said earlier on when you started with economics, and that's balancing between inflation and recession. And basically, the interest rates is the key tool to manage that economic part. But that's not our job. Our job is to get you the cheapest rate, right? That's my job. That's Jerome Powell's job, right?
yes, sir. Cheapest interest rate. Let's save some money together.
Yeah, we'll help you find the best savings possible,
Mm,
and that's what we do. We want to help customers own homes, and
mm.
that's our only objective.
Absolutely, and I think that there is also a lack element because a lot of our viewers are going to be more advanced, so we try to share a little bit more lah. Okay, so sometimes right, there is a lag where people not very sure because when people got window to buy, they wait for confirmation their property in that regard lah, whether for homestay or investment. If it's investment, probably your rental yield is going to look a lot nicer as compared to the interest rates today. Cash flow lah is going to look a lot nicer. And the next thing is that on top of the cash flow, right, it is also going to help with the price appreciation. So there are some people that will want to then take advantage of this, where they calculate their budget and affordability through us. And Sham, when we calculate for our clients, do we always run credit bureau? Yes, we do for certain cases. We give our IPA, our in principle approval, just to look at their numbers and make sure that their numbers are there, and to
Uh-huh.
make sure that we know which bank to go to before we go to the bank. Because in principle approval only for like what 3 weeks before is no longer valid. So do like there are cases, right? There are most of those people that are just looking to buy to understand their budget, to know how much they can actually shop for. They For them, they don't want the credit checks because all of these eventually may
Oh no, then in
lead.
that case you don't need, because what you need
Yeah,
is just our calculator.
absolutely.
Our calculator will tell you exactly where you are standing right now, and
Mm,
how you want to stand in the near future to be enable you to get the desired loan quantum, the
mm,
desired loan tenure, and also the desired interest rates. Our calculator is designed to get you there. It tells you where
right.
you are today. It tells you where you will be once you plug in those numbers. And speak to us. Tell us your story. We love your
Yeah,
story. Tell us a story. We'll plug in your story into our calculator, and we'll spit back the story to you. And this story that returns back to you will amaze you. Let me tell you that.
right. Then after that, we go and do the tweaking and the improvement and the add this and then show
Correct.
this and then do the other thing. Bam,
Correct.
higher loan.
Yeah, we help you manage your TDSR. We help you. We'll help you talk to the banks and on how to handle different things. CPF contribution history, etc., etc. There are plenty of things in the background that's our specialty, that we will help you get to where you want to be.
And now that you talk about this topic, should we give our viewers a little goodie, a little trick on helping with the TDSR? All right, this one is going to be simple. This is with the credit cards. You know what I'm talking about?
Exactly.
Okay.
You want me to tell the audience? Is that what it is?
Okay, you tell. I let you tell. Go. The one statement before statement one, paying.
You know what? First of all, what is TDSR? TDSR is
Total
the
debt.
measure in which the government says you must have the ability to pay your loan. It's just basically, do you have the ability to pay your loan, right? So
Mm,
it's taking all your loan, your current existing loans against your income and say what's the percentage of loan that you have to repay against your income, and the desire and the threshold is 55%. So if you are already at 55% and it's eating into more than 55%, then chances are the loan quantum will be a lot smaller. So what is Ethan talking about when he said let's give you this clue? The clue really is in, if you pay down all your loans, whatever the loan is, credit card bills, etc., car loan, and etc., whatever other loans that you have, short-term loans, and so on, that will reduce your TDSR exposure and enable you to have a much higher loan quantum. So that is key. So when we say we help you manage TDSR, we basically will ask you very intimate questions. We're going to ask you, show us your credit card statements, show us what's your where you are in terms of how much you owe the banks for this loan, for that loan, and then we'll work with you on your cash flow and say, do you have the ability to pay off all these loans immediately, so that your TDSR will reach zero if you can, if not lower than
the debt lah.
55%,
Mm,
right? And with that, then we will with that desired number that we can get to, we will then project what's the maximum loan that you can get.
correct. And on top of that, when you're refinancing and it is an own stay, your total debt servicing ratio can go through exemptions to up to 120%. You make 10K, you can pay your mortgage 12K. But that is based on a lot of different situations. And I think that this kind of things, right? Like you can see how in depth we go towards each recommendation, because the intricacies within each red tape, I would call, is a little bit, is increasingly more and more complex, and we're here to help throughout all these different jargon that people are talking about lah. And that's how we add value. So the next question: interest rates are projected to decline. Okay, interest rate going to decline. Your loan package and lock-in period is going to expire. Do I wait for lower interest rate, or what should I do? Okay. For this kind of rate, right? Year one, usually the rate is happy. Okay. You're going to smile. You're gonna enjoy yourself. Yes. Year two, all right. If your lock-in is 2 years, you are still going to be happy. You're going to enjoy yourself. But so there is this thing, the mother of all hantam rates, thereafter rates. Yeah, typically bad. Okay, it is like SORA plus a ridiculous spread of like 1% or something like that. This is to catch people who haven't refreshed their loan.
Actually, there are two answers to this. Do I wait for lower rates or what? There are two answers. The first answer is theoretical answer. The theoretical answer is it depends on your current situation, right? If your current situation is that you are at the tail end of your current fixed 2 years, this question will pop up, and when this question pop up, the theoretical answer is, well, I have the holding power. I want to, I can wait, and therefore I don't care. Right? That's a theoretical answer, right? Because I have a customer who came to me and said, in August, just this past August, yeah, and said that I want to wait for September because Jerome is going to make this announcement last Wednesday. So I want to wait for it to come, and then I want to take advantage of the loan. But you know what? She can't. She can't wait because the OTP. She signed the OTP, right? And so here's the realistic answer. The realistic answer is that because she has already signed the OTP, she can't wait because she needs to have the LO ready. And so therefore, the answer really is depends on your circumstances. Where are you at that point? If you are at the front end of the fixed 2 years, sure, you can wait. If you are in the in the middle of the fixed 2 years, all right, you have one more year to go. Sure, you can wait. But if you're at the point where you're getting on your OTP or you have two more months before you give notice for refinancing, then that's a different story. Your timing is not synchronized with Jerome Powell's announcement. So therefore, the answer really depends on your current circumstances and how where you are at that point, and wherever you are at that point, reach out to us, let us know, and we will give you the best possible solution.
Correct. So the answer at the end of the day is it depends. Please call us so that we'll be able to help you. So, so next question: if interest rates are declining, should I take a fixed or floating rate package? Can advise? Thanks. No problem. Right, Sham, what is your advice right now? Fixed or floating? Like I said, the numbers were quite close. And
Yeah,
your
we spoke about this throughout the day already.
mm,
All right, it all really depends on where that break-even point is between fixed and floating.
mm,
And because Jerome has made this announcement, the
mm,
fixed rates are declining, and
mm,
so is SORA. And very
mm,
soon they will meet each other. And when they
correct.
meet each other, that's when you make the critical decision. But as long as they have not met the two interest rate lines have not met each other, you can
Mm.
continue with fixed for now until such time when the SORA overtakes fixed, then you go become SORA. So when will that be? That's anybody's guess at this point. But I would think that at some point down the road, and down the road would mean maybe 12 months down the road, the that's where the SORA plus floating rates will become more interesting than it is currently.
Absolutely. And Sham, I think yourself, right? I think it is better to help you visualize by using numbers that you're more familiar with. Okay, imagine it's not $1 million on this screen. Imagine you are still a CFO talking to a company and they are choosing between fixed rate or floating rate. All right. Do you think, right, you would recommend your company to take the fixed rate or the floating rate, although the fixed rate is $397 more expensive in this current political and economic climate? What would you recommend?
If you say it's a company,
Mm.
from a company point of view, $397 is not a lot of money to talk about, right?
10 times
So
$3,970. That is one time holiday.
correct. All right. But if you're talking in multiples of tens, multiples of hundreds, all right, then the dynamics changes. And
Mm.
when the dynamics changes, that's when your decision making will also skew to a different direction. Uh, so it really depends on how painful is that number to you. If the number is really painful, then you make a decision based on the least pain, right? And that my answer to that is really the one that gives me the least pain is the one I'll choose.
Guys, I think now that we've answered most of the questions, Sham, do you have anything else to add on? Any like valuable insights you'd like to pass on to our viewers?
I would like to finish this off by saying that um, our objective. All right, we have two objectives. We have basically two taglines. The first tagline is we smash rates every day. Keep this in
Smashing
mind.
rates every day.
We
Yeah.
smash rates every day. Every day we will help you get the best possible in the market. The second tagline, which is my tagline, all right, and that is we will help you, homeowners or to be homeowners, own homes. And we help you own homes by smashing rates every day.
And for everybody else, right? Honestly, do feel free to ask any questions in the comments below because we understand that there are so many things that we can talk about in terms of just everything that we have. And sometimes it may have a lot of different facets that may not be shared today, but we want to once again help as much people as we can humanly possible. So later after you're done and you want to reach out to us, right, please come in to the link that we have provided, unbeatable for .sg/consult, and then you can come over here, correct? You can type in your details, and then you can come in and then choose which property you have, and then you can choose whether to apply to the new loan, get a refinance, reprice the mortgage. We are here to help. You want to sell your property, you want to make sure you decouple properly, you want to take out money from your property, or you want to have a multi-property portfolio organization straight away, the whole thing, the whole game structured to put you on top, make sure that you have the cash flow you need to retire based off of property alone. And then here is where you can give us a little bit of excerpt, like what is going on and whatever. Then you just click submit, and our team will be with you very quickly. So that's it. Thank you guys so very much for attending our humble talk, and thank you so much for being with us. Thank you so much to lend your expertise as a CFO into helping people. Into honestly, you are pretty much retired already, so thank you for being here. And for everybody else that is watching, really thank you. I'll catch you guys soon. Have a nice day. Bye bye.